Welcome to Dollars and Dwellings. I'm Patrick Diamond.
And I'm Ralph DiBugnara. Welcome to our podcast. Welcome back to the second episode of Dollars and Dwellings. I'm Ralph DiBugnara with Patrick Diamond, and we're here to talk about when real estate meets finance and wealth and everything else that goes along with our daily lives.
Yeah, real estate and personal finance. All right, so we got through episode 1, and that was kind of focused on your primary residence. We covered some types of mortgages. We covered how to qualify for mortgages, down payments. We talked a little bit about costs and fees, not only costs and fees of financing, but also costs and fees that kind of pop up through owning your primary. We talked a little bit about private mortgage insurance, home inspections, using a broker, and where you can negotiate sort of fees and prices.
In the process,
Yeah, you gave some really good tips on that. So I thought for episode 2, we covered a lot in episode 1, but there were a few things we didn't get to in episode 1, so I thought we could kind of circle back on those. So for episode 2, we're going to cover a little bit more about financing, a couple types of loans we didn't get to. We're going to hit on how escrow works, sort of maintenance and renovation budgets and keeping track of that stuff. And then we're going to talk a little bit about buying new versus buying old versus buying a fixer-upper.
Yeah, especially
stuff
today.
Like that, yeah. So kind of going back to financing, there was an article in the Wall Street Journal recently about seller financing, where, and jump in at any moment in case I get this wrong, seller financing, according to the article, because I actually wasn't really familiar with it, but it is what it says is where a seller wants to sell their home, buyers' mortgage rates are too high, so it's kind of scaring buyers away.
Yeah.
So the seller fronts essentially the loan to the buyer.
Yeah, so usually you'll see seller financing in markets where it's depressed home prices and the seller can't sell the house. Like, if I'll finance for you if you'll buy it, but in this situation, it's a little bit different because the seller's going to, even if they give a discounted rate, they're going to get a higher rate for their return on their money. They have all this found equity in their homes over the last 4 or 5 years that they never had before. So they're using the equity they have in their homes to finance the purchase of this house for this person.
It makes sense, right? Because, I mean, at least right now, the best interest rates you'll find in a bank account are a little north of 4. You can get a little north of 5 in a money market fund. Mortgage rates are over 7. Do you know where they are right now?
Yeah, I mean, so where we are today is probably somewhere in the high 6s or the low 7s.
Yeah.
More likely the low 7s. So on a seller finance loan, I don't think that they're going to give a lower interest rate than that. They're not going to give a market rate. It's going to be somewhere between 9 and 12%.
Really?
And somebody would take seller financing if they were having trouble qualifying for a mortgage in most cases. If you can get conventional financing, you usually won't take seller financing. It's usually somebody who doesn't qualify that'll ask for that.
Okay.
So in most cases, they're going to get even though it's a high interest rate market, they're going to get a premium on that rate.
Yeah.
Or else, why would they do it?
Yeah.
You know.
In episode 1, we talked about the idea of waiving inspections, which is a crazy concept to me. But this seller financing also seems like a crazy.
I mean, so I've seen seller financing a lot. As long as you have, if the seller's willing to finance a property for you, and again, it's most likely going to be at a higher rate. Just like any other mortgage, it'll be a recorded mortgage note on the title for the property that has to be paid off for a certain amount of balance.
But how would a normal person selling their house do real due diligence on the buyer, right? I feel like that's just a big risk to take.
It's a big risk.
But I guess if you want to,
and like I said, most of the time you see seller financing, it's mostly in a depressed market where somebody's like, well, I got to sell this home, I'm willing to take a risk.
Yeah.
You know what I mean? In this market, you see where you will see a lot of seller financing is you'll see it on commercial properties. A lot of the time. Commercial loans are harder to come by than residential loans are. So for anything that's, buildings, large multifamily, storefronts, that kind of stuff, you'll see it a lot of times on that they'll offer seller financing and that stuff because it's harder to get financing and it's a different world.
Okay.
And I think you could do a little bit more research. This guy's buying this building to open his business. His business is doing well. Mm-hmm. It's a second location for him. Okay. I know where the money's coming from, but you're right, on a residential property, how do you know if they're going to pay the mortgage?
Yeah. All right, so I guess as this podcast series goes on, I'm going to reference articles I read a lot because I've spent too much of my time reading financial news. But there's been a ton of real estate related articles out there, I think just because the
Sure.
real estate market's so crazy these days. So another financing topic I was hoping we would get to in episode 1 that we didn't get to is VA financing for veterans. Again, there was a good article in the Wall Street Journal that kind of ran through VA loans. I don't have any experience with VA loans,
Sure.
but I know they exist. Some of the things they highlighted in the article that I thought were interesting, and then maybe you can kind of give us your take and your experience on them, were that I guess they historically had a bad reputation because the VA was either slow or sort of inadequate in processing the loans, but I guess that's changed.
Not the case anymore, yeah.
They're available to active duty service members and veterans who are honorably discharged. National Guard and Reserve members may qualify. They don't require a down payment. That's probably the biggest
0% down payment
thing. But they did talk about this concept of like funding fees
Yes.
may apply depending upon like the person's situation.
Depending on your level of service.
Yeah.
Yeah.
So what, you've seen them then?
Yeah, we do a lot of them, and they used to be cumbersome because you used to have to send them to the VA to get sign off on them. Now, as long as you get the certificate from the VA saying this person's eligible, it's a certificate of eligibility that you have to get from the VA as either a service member, active, or a former service member. And just for the record, the qualifications are: you have to be a wartime service, give wartime service for at least 90 days,
Okay.
or be active military for at least 180 days.
Okay.
And you qualify in most situations. So it's not a crazy requirement.
No.
And that goes for National Guard, that goes for, any kind of Bureau of Service. It's a 0% down payment in most situations, and there is a VA funding fee, which it's escaping right now, but it depends on your level of service, but they actually waive in certain situations. I don't know if you had that.
I think the article quoted, they said rates range from 1.25% for a first-time user with a down payment of 10% or more towards 3.3% for a subsequent user with no
Correct.
down payment.
Correct, yeah, that's accurate. And the thing with the funding fee is that there is a funding fee, but unlike other government loans like FHA loans, on VA loans, there's no mortgage insurance.
Mm-hmm.
So although you're paying a funding fee, you're saving in other places where you're putting down 0%. In most cases, you have to put down at least 20% to avoid mortgage insurance, although we talked about that last episode.
Yeah, go back to episode 1
Yeah.
for the conversation.
There's other options there, but
private mortgage
the
insurance.
VA
PMI.
loans are 0% down payment and no mortgage insurance. So although there's a funding fee, there's no mortgage insurance, and you can get into it with no debt. So for anybody who was a service member or who had a family member that was a service member, they're very, very useful loans.
Yeah, no, it sounds like it. And it sounds like they're getting better. It did, I guess one recommendation the article said was that use lenders that process a large number of these loans just because they have the experience, they're good at it, they'll move through it.
Yeah, I think like anything else, you want somebody who understands the process and understands the eligibility certificate and what you qualify for and what you're not going to qualify for. But yeah, I mean, there are companies that do a ton of these. I mean, at this point, we have so many service professionals in this country that there's a lot more of those loans. We do a significant amount of them at Cardinal, but in general, it's a pretty common loan these days.
Yeah. Are there any, I guess if they said they were bad in the past, are there loans right now that you're like, oh no,
Don't do those?
Don't do those.
Stuff that used to be, I think technology has cured a lot of the ills with a lot of the loans. Some loans that still can be problems are when you have state-run programs.
Mm-hmm.
Like New Jersey and New York both have, just because this is where I am actively, have programs. New York has Sony May, and New Jersey has HMFA.
Okay.
And those are state-run programs.
What does that mean exactly?
They offer you essentially no down payments or down payment assistance on those programs specifically because they're done through the state. So it's great for that, for residents
of those states.
But it's a lot more cumbersome of a process.
Mm-hmm.
It's a little bit out of the bank's control. That's because the bank has to send it to the state to essentially finish the underwriting on it. So you have to have a certain amount of time. And in a market where there's bidding wars and sellers have a lot of advantages, when they see that type of financing, they may balk at your offer. So it's something to be it's something to explore, but just make sure you have the right type of purchase to use that type of financing.
You might need a plan B.
Yeah, exactly.
All right, great. So I think that sort of ends, like I think we said in episode 1, like we could do a whole episode just on mortgages, but seller financing and VA loans I thought were interesting.
Yeah.
And I'm glad we could circle back on them. Let's talk a little bit about the concept of escrow and how escrow works. So I have a mortgage still, a 15-year fixed on my primary residence. I have a mortgage servicer, so I send my payments to them, and that payment includes payments for my real estate taxes and my homeowner's insurance, and that gets held in escrow.
Correct.
And gets dispersed
Quarterly or monthly or whatever it is, yes.
Yeah. Have you always basically used the servicer, or have you?
Yeah, I mean, if you have enough discipline to pay your taxes and insurance on your own, it probably saves you some money. Not a significant amount of money, but it's a big lump sum of money. So basically,
it's pretty convenient. I kind of feel like I didn't actually know that I should have assumed that there's a fee.
Yeah.
But it's a pretty good service.
It's easy to budget if you know exactly what you're paying every single month, and you can split your insurance and your tax payment over months instead of, hey, at the end of the quarter I have a $3,000 tax payment, or at the end of the year I owe $4,000 for my homeowner's insurance. So I think it's beneficial to do it that way. At the end of every year, the bank or the mortgage servicer will do an escrow analysis to see if you overpaying into it or underpaying into it, and they'll either issue you a check or increase your payment.
I think I've only once got an escrow reimbursement.
I actually just got one,
and I was like, oh, sweet.
Yeah,
it's never happened again.
Yeah, it doesn't happen that often because sometimes they overestimate up front when they first escrow the account, so you get money back, or sometimes taxes and insurance change. But yeah, at the end of every year you'll get an analysis. But I think it's beneficial. Yeah. I'm with you.
I should have assumed. I don't know why I didn't realize there was this fee tacked on somewhere in there.
Yeah.
It's not. I guess it's not transparent.
No, it's not.
Yeah. But that's a great segue into some other. Again, in episode 1, we talked a little about costs and fees. I wanted to talk about homeowners association, like buying your primary residence. If you buy in, I guess, a community, essentially, there's homeowners association fees sometimes. Or if you buy a condo or a co-op in a city somewhere, there can also be co-op and condo fees, or like in New York City they call it maintenance fees.
Maintenance fees, yeah. It's the same thing, really.
Yeah, and at least in New York City, the maintenance fees they're like another mortgage.
Yeah.
They can be huge. Have you had experience with HOA fees?
I do. I have a couple of condos that have HOA fees or maintenance fees, and it's nice for convenience. I don't got to worry about snow removal or garbage pickup or fixing anything anything from the walls out of the property. So your roof, your siding, your sidewalk, anything like that, you don't have to worry about. In a lot of cases, your landscaping, you don't have to worry about. So it's great for those purposes. But it's a lump sum fee you're paying every month. And if there's any problems with the building you're living in or the association you're living in, and it's going to cause significant repairs. Let's say it's $100,000 to fix something within the sewer system or the cable wiring within this association, whatever it is. They will then divvy that up amongst the homeowners, and that will get tacked onto your HOA fee. So that could be a problem, if there's a shortage.
Right. So I assume that's got to be written somewhere in some kind of document that you a lot of people probably don't read and sign away. But again, the importance of reading the documents you're signing.
Yeah, and an HOA is going to have a board, and they're going to have board meetings either quarterly or yearly. We can go and discuss what they're actually charging, what you're being charged for, and what's upcoming. I even have a property that the beaches are eroding. There's an HOA, and we had to buy sandbags. I actually don't have the property anymore, but I did. And we had to buy sandbags to stop the beach erosion. And that was like a $300,000 purchase of sandbags. It wasn't like a small purchase.
Yeah. And you see that concept pop up. I know my sister, who has a condo in Brooklyn, her building, I believe they had to repoint the brick facade on the whole building. And in that world, it's called an assessment. But they assess it to every owner. To your point, it gets divvied up, and everyone kind of has to pay for it. And I think people can complain to the condo board, but somebody's got to pay for it, and it's the owner, and it's going to be.
And in that situation, if you're going to buy in a building, whether it's a co-op or a condo or an association, I think it's very important to know who's on your association, because I know a lot of property management companies and maintenance companies and stuff like that, and when the HOA is just deferring to the maintenance company or the management company to find contractors to fix the repairs, this fee's added. So I think it's very, very important that whoever's running your board or is involved in deciding who the contractors are is somebody that you trust with the expenses of your home.
Yeah. So I guess all of this, I'll put my lawyer hat on for a second. All of this should be disclosed in a document somewhere, but I mean,
there are bylaws for every single one of these.
Okay.
For sure, definitely, yeah.
I mean, I'm guilty, but I'm definitely guilty of, I mean, I remember my closing, like the amount of documents you have to sign at the closing. If you're gonna sit there and read those documents sentence by sentence, you'll be there for a week.
And by the way, that process is getting more and more streamlined at this point as technology takes hold, and there's less and less documents there's more documents you get during the process at this point, but less documents at closing, so it's not overwhelming. There's still a lot of documents, but the process is getting more and more streamlined.
Yeah, what advice would you give to someone who's out there looking for a home, knowing the sort of deluge of documents is going to come? Can you even request those documents in advance to read them?
Yeah, I mean, so at this point, you're going to get a loan disclosure package 3 or 4 different times during the process. So when you initially decide you're going to do a loan with the company, and they have to disclose really within 24 hours to you. As soon as they put an address on your file, they have to disclose it. So you get initial documentation. Then when your rate is locked, so when you lock in your rate, you have to get another set of disclosures. Then when the final documents are ready, you're going to what's called the closing disclosure along with the rest of your documents, and you'll get that usually at least 24 to 40 hours before your closing. So at least 3 times during the process, you're going to see these documents. You'll have time to question them. Your closing disclosure, you really, unless it's a crazy rush and something happened, you really should have at least 24 to 48 hours before your closing to review and go through and ask about fees and stuff, that kind of stuff. But it's a lot different world than it used to be, where it's at least 3 times during the process you will get disclosures.
And I assume another good reason to use a broker you like and hopefully trust, and that they'll, like, at least they're telling you, like, that document's pretty standard.
Yeah,
you don't have to read the whole thing,
yeah.
But hopefully they can point out where HOA fees.
This is where this comes in.
Are.
Sometimes the cheapest deal isn't the best deal.
Right. I always like to say cheap work ain't good and good work ain't cheap.
Yeah, on interest rates specifically, so this is something the general public should know, and I'm sure we'll get into a conversation about interest rates in general, but essentially 99% of the banks in the country are dealing with the same rate sheet. It's all how they kind of manipulate that rate sheet, like anything else.
What's a rate sheet?
I'm sorry. So interest rate. So as a mortgage person, you're going to look at an interest rate sheet every single day to decide what that person qualifies for that day, for that hour, for whatever that time is, right? That's a good slow me down, right? That's a good question.
Terms of art are tricky sometimes.
Correct. So we're all dealing with same interest rates essentially. It's all how that bank's going to manipulate that interest rates. But a lot of times when banks are manipulating that interest rates, your service isn't going to come or go with that interest rate. Like some places is just a factory. They're going to give you the lowest rate, but they're going to push you through the process, and they're not going to explain anything as you go through. Mm-hmm. Some banks are a little bit, there's a little bit more of a lengthy process because they want to explain everything to you, and they're going to speak to you about home warranties, and they're going to go through that process. So you get what you pay for is my point. So it's just something that you need to examine before you just jump at the lowest interest rate in the market, because it may not be the best deal for you. So it's right. Something to kind of examine as you go through the process.
And I think it's like a life lesson, and it comes up in a lot of areas, but you have to have the confidence to, like, have your street smarts and say, like, this process is moving too fast, or I don't understand what's going on, or I'd like time to read this document. Yeah. I think you have to, don't be afraid to do that. Like, yes, somebody might be in a rush and might not be thrilled if you want to read a giant.
You should.
But you should.
Yeah.
And it's your right, and screw them.
Listen, you're starting a contract for 30 years essentially in these loans, so you should. You want to.
It's a big decision.
You want to know what you're getting involved in, and at the same time, like any other business, you think yourself as a business. If you should, where's the money going? Where's my money going to? Okay, I'm willing to pay more for this because I'm getting this. So but think of yourself as a business in that situation. But the cheapest isn't the best sometimes, and the most expensive isn't either. So it's just important that you kind of examine that process.
All right, that's great stuff. I think we'll sort of jumping around a little bit. Let's talk about the concept of, so in episode 1, you talked about having an exit strategy on a property, whether it's a primary residence or an investment property. But let's talk about the idea of, some people use the term holding period, but it's really like, how long do you have to live in a house for it to be a good investment, and you get some kind of return on your investment?
Sure. I think that's fluid. I believe that in a time like today, right? In a time like today, what we're dealing with nationally is a national inventory shortage. The beauty of that for somebody who actually owns a home is you're getting accelerated equity in your home your home is becoming worth more faster in a market like this because homes are selling so fast.
Yeah. I can say, I mean, when I bought my house, I feel like the value of my house, again, I bought at the lows of
You bought it at a good market, yeah.
of the last kind of housing downturn, but the value of my house didn't seem to move for a long time, and then all of a sudden, like, you know, recently it's shot up, which is nice for me, but
yeah, I mean, so I have
it takes a while.
I have a specific formula on investment properties that's a little bit different than the house I live in, right? So if I'm buying something that it's primary for investment, right? And that separates too. I own long-term rentals and short-term rentals. And I'll just find that real quick for you. A long-term rental is anything over 6 months that's leased or rented for anything over 6 months. A short-term rental is a 30-day rental or less. So essentially Airbnb properties and traditional rentals is what I own. On an Airbnb property, because in my opinion, the way I view it is a bigger risk because there's much more turnover and there's much more chance of vacancy and people not being there. I really want to have my initial investment back between 5 to 7 years at most, but that's what I look at. Like,
Yeah.
I anticipate making this much per month in profit after my expenses. I should have my initial investment, and my initial investment is going to be my down payment, my closing costs, what it costs me to furnish the house, my repairs, all that stuff. I want to have that initial investment back in 5 to 7 years. On a primary residence, a home I live in, I have a little bit of a longer term plan because for me, I have family, my kids are in school, I'm gonna be in that home for 7 to 10 years.
Mm-hmm.
So in that concept, it's like, hey, I want to get my initial investment back with some profit in 10 years. But it's different for everybody else. You know, you may be buying a starter home where you're like, hey, I'm only gonna live here for 3 years. What am I willing to risk for that 3 years? Do I have to make a profit? So I think it really it's very specific to what your goals are.
That's a fair point. I mean, we talked about all the fees and costs that kind of go into this process, but again, it's you don't necessarily have to look at it as a return on investment. I mean, you need a place to live. If it's a starter home, yeah, you're probably not going to live there that long.
Forever, yeah.
Maybe don't overthink it, but at the same time, you know, it is a big financial decision,
It's
and
still
you want
an
to
investment. Yeah,
you want to make the numbers work for you.
But I also think be realistic about it. If you look at the greatest investors in history, and you could probably talk this better than I can, but I think Warren Buffett is somewhere between 10 and 12% return on his money in history. He's like considered one of the best, and I don't even know if it's that high.
It's I mean, he always talks about his track record of beating the S&P 500, and I feel like there's always that like 7 to 10% number
Correct.
thrown around
Yeah.
on like the annualized return of the S&P 500. But
So my point being on that is if you buy a house for $300,000 and in 3 to 5 years you can make $30,000 in profit on that, that's a 10%.
yeah.
If you invest $300,000, that's a 10% return on your money. I think be realistic about it. Like, you may not make $300,000 on a $300,000 investment. You know what I mean? Like, it's not realistic. So I think we have to look at homes as another investment vehicle. And again, this is more your field than mine, but like, what is a realistic return on that property? Like, if I can make 10% on my money, so if I make a $50,000 investment, I can make $5,000 back. It's a pretty good return on my investment. You know what I mean? Like, so I just think that we have to kind of be realistic about what that return should be.
I mean, I think back to I guess I feel like the scars of the 08, 09 crisis, right? Like I definitely, and I'm sure you would probably experience it personally, but I certainly knew people who, you know, they bought at the highs of 07, right? And those people were, you know, they use the term underwater, meaning your house it's worth less than you owe on your mortgage,
Yeah.
right? And that was a big problem back then. People who bought at the highs of 07, and then the crisis hit and home values dropped. It took some of those people a very long time for their home values to finally catch up to how much they owed on their mortgages.
Right.
So fast forward to where we are now, and I kind of see what's going on in the marketplace, so when clients come to us talking about, oh yeah, we're going to buy a place in Florida, and I'm like, all right, you can afford it, but also don't make sure you're paying a fair price, right? Because being underwater, you don't want to be underwater on a property.
No, and that's hard. Listen, I bought properties in 05, 06, so before pre-crisis in Florida, that it took me, I don't know, 13 to 15 years to get my return on investment back. And so
13 to 15 years, yeah.
So I got it.
That's a long holding period.
It's a long holding period. That wasn't the plan. Like, that wasn't planned.
That wasn't the original exit strategy.
No, so, you know, I just think you have to be kind of realistic about, you're right, don't overpay, where you're buying is important, and we'll get into this at some point, but buying today is kind of, It's a double-edged sword because yes, interest rates are
Double-edged
higher.
sword?
Yeah, interest rates are higher, but when interest rates drop, at some point in the next few years, you'll see an interest rate drop. Some sort of interest rate drop. I don't think they'll go back to the 2s and 3s, but the interest rate drop. There will be a feeding frenzy to buy real estate again, in my opinion. Some sort of increased level of buying. If that happens and you own a property already, you will get built-in equity into your home without you doing anything for it. So yes, you're paying more for it now and you're paying a premium at a higher interest rate, but you also may get money that you wouldn't have gotten in a normal market because you bought earlier than the next person.
Yeah.
So it's something to think about.
Yeah. I mean, this is all interesting because it's such an interesting time. I mean, we talked about it in sort of the intro to the podcast with how crazy the market is right now. And, you know, it's hard to see what would cause, given how much the shortage in inventory, it's hard to see right now what would cause home prices to drop like they dropped in the 08, 09 time period. But at the same time, as a financial planner, I'm still very nervous that my clients are overpaying for properties. Yeah. So it's just, that's
you're 100%. I mean, listen, I've seen some of the markets that I bought in over the last like 4 years that prices aren't like, they're not down 30%, but they're down. Mm-hmm. You know what I mean? Like I definitely, there's a couple of properties that I've purchased that I feel like I overpaid for. Uh-huh. So, you know, just having a plan based around that is definitely for sure something that's important.
I want to come back to that because I had a note on, since you mentioned it, there was another article on some of the new buildings in Hudson Yards on the west side of Manhattan, and how demand there has been softer than anticipated. I mean, they're all extremely expensive apartments.
It's a small percentage of people that can afford it, yeah.
But people have bought into some of those new buildings, and now they're not going to, if they're looking to sell, they're not going to get anywhere near the price that they paid. So, you know, that's just one current example.
And by the way, in the luxury condo and co-op market, and I think in the condo market in general, you're buying condos for convenience, right? I'm moving in, I just have to go to my apartment, I turn the key, I go into my apartment. In most cases, I don't have to do anything. But in most cases with condos and co-ops, you're not going to see a huge increase in value, but you also won't see a huge decrease in value. They kind of stay around where they are. It's not single-family homes or multifamily homes, you'll see more fluctuation in the market than you will most of the time in the condo market. Mm-hmm. It's a stable buy, but it also may not be a huge investment that you're going to get a huge return on your money on. So it's just something, you're paying for convenience in a lot of those cases, so it's something to look at.
Okay, cool. All right. So also, as a financial planner, we always focus on the concept of an emergency fund with clients. And in the general personal finance world, we talk about an emergency fund being literally cash savings. So like cash in a savings or checking account, or maybe a money market fund to cover, it varies on a person's situation, but the general rule of thumb is 3 to 6 months of fixed expenses. So fixed expenses being like your mortgage payment, your car payment, health insurance, things like that. When it comes to either a primary residence, or you can even talk to investment properties, how important it is to have accounts to basically budget for maintenance and renovations on an ongoing basis. So basically an emergency fund for your property.
Yeah, and I'm in mortgages over 20 years, so I'm in mortgages long enough that I've seen a million mortgage applications, whether refinance or purchase, whatever it is. So I want to tell people who are listening to this, 95% of the world can't afford to keep 3 to 6 months of reserves, even though that is ideal, right? I think
there's some horrifying statistic about how a huge percentage of people can't come up with $400 to cover an emergency.
It's 1,000. I mean, I started in this business doing a lot of refinances, so you see people's finances, and there's no money there. In most cases, your mortgage is your money, your savings for that month. And listen, it's an investment. But I feel that at least 2 months of your mortgage payment is what you should try to budget for to have, because your water heater goes, the dishwasher goes, your washing machine goes, anything can happen, and it can be a huge expense that you can't just not fix, right? You have a plumbing issue, so. You know, for those purposes,
I'm waiting for my hot water heater to
you need an emergency fund, and that's a good point. Like I had a hot water heater go a couple of years ago, and if I didn't have the means to fix it, so what happens? My family just goes without hot water
Especially if it's
in the middle of winter.
In winter.
Yeah, so I think it's important to have that fund there.
Because hot water heaters only break in winter.
Winter, yes, always, yeah.
It's a law of the universe.
But it's a good point. Like I think, like even on my investment properties, I try to have 2 to 3 months of my mortgage payment in my bank account before I take any money out of that account. So like I review my investment properties quarterly, right? So I'll go to the quarterly.
Oh yeah, you get real deep. Take us through the detail you go through with your investment properties.
So on my investment properties, I keep a maintenance log, and every single investment property has a separate bank account, and I at the end of every single month I do the accounting on that bank account. So what money came in, what money went out, whether it's the electric bill or the water bill or whatever, what my expenses were. So I actually go through the process of, you could do it on an Excel sheet or a Google spreadsheet or whatever, right? But I go through the process every single month of looking at the expenses and the income for each property, so I kind of know where I'm at, and I think that's important. But at the same time, at the end of every single quarter, I'll look at every single house and say, hey, how much money's in my bank account? What my expenses? Can I take a distribution out of this account to recoup some of my initial cost or my expenses that I put into the property? If I don't have 2 to 3 months of my mortgage payment in that account, depending on the property, I won't take a distribution. I leave it alone. And if I do, then I start to recoup some of my investment. But yeah, I keep and maintenance logs are really, really important, even for your primary residence. On July 1st of 2023, we had a clogged drain. So-and-so plumbing came out, they cost us $200 to clear the clogged drain. So in 2024, when you have a clogged drain again, and you have to call somebody, one, you have a plumbing company to call it, maybe you're starting to examine, like, why do I keep getting clogged drains?
Right.
Is there a bigger issue? Or maybe this guy didn't do the job.
Maybe he didn't do a good job.
But yeah, I think it's, for your primary residence, you should run it like a business. Like, it's very easy. I use Google Drive, and you use iCloud. But like, I keep a drive for every single house with all my receipts for that property, my homeowner's insurance, my tax bills, my water bills, like, so I just have to search. If I need something, like, what was my water bill for last year? This is crazy. Let me search March of 2023 what my water bill was. Oh, it was $400 that month. It must just be the time of year.
Yeah.
So it's good to keep records.
It's a great point, and it touches on a couple different ideas. When tax implications, there's this concept of cost basis for your, especially for your primary residence, but also for an investment property. The cost basis is how much you paid for the house. When you put money into the house, usually through a renovation, but sometimes it could be maintenance as well, that extra money you're spending on the house increases your cost basis. And okay, why is that important? Because someday when you go to sell the house, you may have a gain or a loss, and that's sort of dependent upon your cost basis and tracking your cost basis. So to your point, keeping these records is really important, not only for being able to cover expenses as they come up and managing them, but also for managing essentially your taxes at the end of the day. And you could be in a home for 10, 20, 30 years. It can
be a huge benefit at the end of it if you manage in the right way too, because not only does it ever repair something you may be able to write off at some point, but the IRS looks at those repairs in certain ways where, and I've had this conversation with you previously, like they may look at a roof repair, it's like, all right, you had a $30,000 roof that you had to put in the house. That's great, you can take that expense, but it has to be depreciated over a certain amount. There's other things that go along with it, but the more data you can have on it to look at, the more beneficial it will for sure be for you in that situation.
Yeah. And I think the big takeaway is record keeping for your home is incredibly important. Definitely take advantage of technology.
Yeah.
You want these records digitally at this point because it's that easy to do now.
Yeah, and I didn't always do it either, and it was a really big mistake because I went back and look at stuff to try to make decisions on whether to buy a property, whether a property was actually making money, or whether my primary residence, what's going on, why these expenses so much. I didn't have records, so it's important to have something to look back in your track record, not somebody else's, to what's going on with the actual house.
Yeah. Good luck finding that paper receipt 15 years from now. All right. So we covered some good stuff, but the main topic I was hoping to get to for this episode was buying a new property, so like new construction versus an old property. And I guess old properties kind of fall into the categories of like fixer uppers and like turnkey.
Yeah.
Meaning like you just it's pretty much great. You just move in, everything works. And again, it comes back to the idea of it's kind of a crazy real estate market. There's record low inventory. So in a lot of parts of the country, new construction is the only game in town.
Sure.
What would you say to somebody who's looking at a new, either something that's actually been built or something that's maybe not even built yet, but it's basically a planned development, it's underway, and you can get in sort of as construction is ongoing?
There's a stat that came out, I believe, in July or early August that said the prices on average throughout the United States between newly built homes and what's considered an older home is the closest it's ever been. I think it's a $16,000 difference between the two of same size, right? And I think the reason that's happening is because of two reasons. People are being forced to buy older homes right now because there's not a lot in the market, so you kind of buy stuff that you wouldn't normally buy and then you put the work into it. But I think at the same time, for newer builders, there's such an abundance of people looking that they have to do less, right? They can use cheaper materials. They can make these homes smaller. They don't have to offer additional amenities in these properties. So, not that I wouldn't say that the quality of new builds is getting worse, but I will say that they're going to offer you less at this point. So it's something to look at. Yeah, it's great. You move in, it's turnkey, but at the same time, you may be getting less than you would think on a newly built home because there's such a demand that they don't have to give you as much. Mm-hmm. And on an older home, I really feel like the only way to buy anything of any value at this point now, where I'm going to buy something and it's going to be worth what I paid for it in most situations, is if you're willing to do some work on that home yourself. Because if you are willing to do that and put some improvements, and they don't have to be expensive improvements, just improvements.
Right.
You'd be shocked at how much just redoing a kitchen or just refacing your cabinets or putting under the counter lights, cheap under counter lights, will do for your home. But I think that's the best way to buy a house and get some value in it, because you're buying something that would be a lot more money if the work was already done.
I've read that fixer-uppers are staying on the market longer because, I mean, I'm not a handy person. If I bought a fixer-upper, I would have to hire tradespeople to come in and do the work
Likewise.
for me. Yeah. But we all know there's also, tradespeople are busy. Not enough people are going into the trade, so it's not easy to find a carpenter, a plumber. But so if it makes sense that fixer-uppers are not as attractive right now as they have been in the past. On the flip side of that, to your point, new construction comes with its own problems, right? And it goes back to what we said earlier about reading documents. Like if you're buying new, there's going to be a contract probably around that.
Yeah.
And the contract that's something you have to read closely, because apparently it typically gives the builder an ability to either make changes essentially.
Yeah,
so if they're having
more
supply issues, they can use
cheaper materials. Correct. There's going to be, on a lot of the stuff you're buying, especially appliances and stuff, there's going to be warranties on stuff when you buy a new build, so that protects you a little bit. It's important to kind of know that stuff front. Like I bought the home I live in now was really a new build, and I had coverage from the builder for like a year afterwards on most things. So it's good to know.
Did you have to actually use that at all?
A little bit, yeah. There was some things that
And they answered the phone?
Yeah, they amazingly answered the phone. They amazingly did it. They came out and fixed it. It was a reputable builder. I think that's important too.
Good point, yeah.
Is doing research on the builders. There's plenty of large builders out there in states like Lennar and Pulte Homes and stuff like that, who are reputable builders that have warranties and all that. But it's important to know who built the home. It definitely is, because stuff may look nice, but the toilets may be cheap. They may be tiles that they got cheaply at Home Depot. Something that's a really big problem a lot of times is the plumbing and the electrical, if that was done cheaply, because that could cause massive problems down the line. So it's important to know that you have a reputable builder, especially if you don't know what you're looking at, like me. Like I could tell you, you know what I mean? Yeah. So like when the tile that they laid is kind of mismatched and I'm not understanding why it's not lining up, that could be a huge problem lying underneath that I have no idea about. Yeah. So it's important that you know who put the house together.
Yeah, the things I've read, again, reading the contract closely is important, because they can change materials on you, but they can also increase prices on you if like we've
materials,
had inflation problems recently. And then you gave some great tips in episode 1 on walking around with your home inspector when it's inspection time. They say same thing with new property. You to your point around like electrical and plumbing.
Yeah.
What I read is if you're buying new, you
cut that out.
You want to if you're buying new, you want the opportunity to do inspections at multiple points in time, like before drywall goes in, so like the inspector can see electrical and plumbing.
If you can get to a house early, it helps. Especially, and again, you would be shocked at how much electrical and plumbing work. Like, if I could tell anybody to go into a profession, it may be electrical or plumbing, because there's a lot of problems that could lie beneath on that stuff too. So if you could see the walls before that stuff is put together, it's a huge benefit to you.
Yeah. So buying new, buying old, do you have, in your experience, have you done one more than the other?
No, I've done both probably. I'm probably more older than newer, just because there's more of it.
Yeah.
And I've had good and bad experiences with both. I bought new properties I thought looked great when I bought them, and within a year buying the house, stuff started falling apart because it was cheaply made, or cheap materials, or so it's.
You said the region also plays a big, like, there's not a lot of new construction.
Yeah. Depending on where you are.
Single family home new construction in like the tri-state area here in the Northeast.
Like in the Northeast, if you're going to buy something that's new, it's going to be a flip, not a new construction.
Or like something really expensive.
Correct. And then yes, a complete knockdown and build back up again, which is going to be really expensive. But in both those situations, you better make sure who did it is reputable, because there's a lot that can go wrong with that stuff. So listen, it's better if you could buy something that needs surface work and not like a ton of work, but stuff that makes the house look better. That's not going to be super expensive, because you can get a lot of value in that when you buy the home, in my opinion.
Yeah.
It's the best way to buy it.
Okay. All right, so I think we're going to wrap up sort of episodes 1 and 2 covered a lot on buying your first primary residence. I'm going to end it by the best tip that I ever got going into the whole process was, and this is my sister gave me this tip, was be willing to walk away. Do not fall in love with a house. Be willing to walk away. And I do think that is great advice, because then you possess the ultimate bargaining power if you're willing to walk away. Do you have?
That's a really good one, because people fall in love with homes that aren't theirs a lot. I think the biggest thing I could tell you going to the process is, don't wait for a mortgage professional or a financial professional to tell you what your budget is. Go through every single one of your expenses, your cell phone bill, your electric bill, whatever it is, right? Your streaming services, and find out exactly what you're spending per month and what you can afford to spend on a home, and create your own budget. I'm comfortable spending $3,000 a month. That's all I'm comfortable spending. And know what that is before you go into a property. So I think that's the best thing I can tell you.
That's great advice. That's the advice I should have said as the financial planner.
Yeah, that's good though, because opposite.
All right, well, thanks for tuning in for episode 2. I'm Patrick.
I'm Ralph.
We'll see you again soon. This is your co-host, Patrick Diamond. I'm a vice president and certified financial planner with Wealth Management Resources in Smithfield, Rhode Island, where I serve our investment customers as an investment advisor representative. My co-host is Ralph DiBagnera. Ralph serves as president of Home Qualified, the digital resource for buyers, sellers, and real estate agents. He's also vice president at Cardinal Financial, a nationally recognized mortgage loan company, and he's the recent author of The Growth Trap, a continuous plan to avoid the traps of life and build a better you. Our discussion is not tied to the offer or sale of any investment products or products in general. This podcast is for informational purposes only and is not meant to be legal, tax, or investment advice.